Hi, hey everyone. I just wanted to do a quick video on theta decay and timing of options. Some of the feedback we've had has been around people saying that the options we're trading they're too far ahead in their time horizons and around their time frames. And why can't we do things in a shorter period of time? I think something we need to try and I need to articulate to people in a much better way is that we're not that there is a mindset to hold to expiry, and that mindset I don't know that I think that's become because people kind of make a purchase of an option. You know, they might make a purchase of an option that's got 30 days left, and they want the market to move where they want it to do in those 30 days. That mindset will eventually take its toll on your P&L. And what people need to kind of start to understand is that the option, much like the futures contract, you might buy a March future, in crude, for example, at $54, and you'll hang on to it for a few days or 5 days or whatever it's going to be, then you get rid of it. That you need to see the option as that tradable asset, not as that entity that you're keeping to expiry. In most successful operations, you do not want to be holding the option to expiry. I've said before, if it starts with a 2, you must not do. And let me explain that a little bit more. So, without showing the kind of the spread that we've done for our members, which you've all seen, I've just put something up in the ES. Let's add a few more strikes in here, and this is a March. Sorry, I beg your pardon. This is a June put spread, and it's got 126 days now. For instance sake, if you are looking for downside play in ES, the lowest cost timing of that process is going to be handling that in a date that's slightly further out. So kind of let me just show you what I mean by that. So if you think ES, as an example, is going to go down, I think this option's only got 20 something days left. So let's structure something similar. So we want to buy some downside, get rid of it again. It's just a similar call spread. I think they're roughly the same strikes. So where are we? 26.70, 27.50. Now I've messed up that a little bit there. I apologise. Let's move that down a smidge. And where are we? 26.70. Okay, cool. They're roughly the same now, but they're just dates apart. So you'll see people look at it and go, "Oh well, I'm not gonna do the June because it's 26 handles. The cost is right here. I'll do the March instead." But that's where the fallacy of many people that are trading options kind of comes in, is that the risk to you if you're long options is in these sub 35 days. You look at the decay here. It's a bit like buying a new car, and you're gonna assume it's dropped down here from the forecourt already. So let's say you bought a car that's kind of a year old, and make that example a little bit better, and you hang on to it for a couple of years. The price drop isn't that bad. It's just the 25% up here, okay? And then you dump it onto somebody else because the warranty's gone, or the inclusive service is disappeared. Okay, let that person deal with the car to collapse into nothing, because that's where all the mass decline is. So what we are looking at establishing is living in this space where we only see options. We're actually coming into it about here, so we only see this amount of decay. So if we go back to that previous option, this here is similar structure. This has got 28 days left on it before it dies, and you've lost all 18 handles of what you've bought there if you're wrong. Whereas this option here is, even if we moved up, so let's say you were wrong, this is where we'll see some differences. If you were wrong, and let's say we go to 2800, okay, in the futures contract, right? That's now dropped down to 20 handles. Okay, let's say that took a little bit of time to go. It's an unfair outcome. Let's say it took 26 days to go, so we've got 100 days left. Okay, even with 100 days left, 26, you're looking at you still got a fee paid there of 20 handles. The days have not really impacted it that much. Now let's do the same on this future. Let's go to 2800, and let's say it's only got it's 4 days left because we took 4 days off there. You've done all your money. It's all gone. The whole structure that you've purchased is worthless. People need to get their minds outside of this zone. This is going to bankrupt people, and this is how market makers make their money, because people hang on in the death zone here, thinking they're going to get a win. We're looking at the structures that are from 100 days onwards, maybe 120 days, through to about 50 or 60 days. This area here where we're not seeing much decay, we need everything working in our favor. The last thing you want is an asset, where, you've bought an electric car, the battery's gone, the wheels need changing, the engine's screwed. That's what's going on here. And every now and again you might get a winner and nothing goes wrong with them. But most often than not, that end of the market is a pile of crap. And so when we put a structure up for for June, we're not saying hang on till June. We're saying it's really, really low cost to engage in that space for the next 50 days. And that's why we're moving towards that. We're not saying, we think something's going to happen, it's going to take till June. We've put a trade out at the moment in the sterling, and some of the feedback's been, what's going to happen in June? Well, nothing. We don't care about June. We actually think it's going to happen in the next 60 days, not the next 120 days, which is going to participate in this zone here. We're looking for the lowest risk that's in our favour in a period of time that's not going to decay on us. And hopefully, just by showing that very rough example there between the trades that I just showed you, you can see that. So it was just really we hopefully enabling everyone, when you see a trade that's for 200 days out, look at the time frame of what we're looking to hit target. We are never going to be holding our options into any OPEX zones ever. I can pretty much guarantee, unless there was literally some massive change in macroeconomic circumstances and there was a free ride we could jump on, it is most likely we'll never be in that space. So the expiry of the option is irrelevant. It's how much of a cheap, low theta burn zone that we want to exist in. That's hopefully has helped that. Any questions, just ping them to me. Thanks.